Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on this afternoon's market action, because when you take a look at the major averages, you can see we aren't too far from the flat lines. It looks like investors are really in that holding pattern right now. The market's in a holding pattern as we do closely watch the debt talks down in D.C. President Biden and House Speaker McCarthy are expected to meet here later on this afternoon. When you take a look at the movement today, the Dow off just about 60 points. S&P and Nasdaq, though, holding on to gains. And Nasdaq, the outperformer of the three there, up just about 0.7%. We take a look at the bond market action. We are seeing yields rising here. The 10-year yield right around 371. We did get some comments here. Minneapolis Fed President Neil Kashkari signaling earlier, Akiko, that he is potentially open for the Fed to slow down, signaling that maybe we could see a pause ahead. So again, just the latest Fed president to come out saying that, hey, maybe our work is done for right now.
Yeah, he did say, though, we could see a pause, but we don't want it to be the end of the rate hiking cycle. So we're going to keep a close watch on that as well. As we keep one eye on Washington, though, we are keeping an eye on the macro story for the markets. Bank of America seeing more upside ahead and raising its year-end target for the S&P 500. Strategists now calling for the S&P to finish the year at 4,300, even as markets have been stuck hovering around 4,200 amid the looming debt ceiling debate. Now, they say easy earnings growth is in the rearview mirror, so companies will be focused on structural benefits, including artificial intelligence and automation. And Shauna, we should point out year-end target of 4,300. It was at 4,000 before, so a little upside there from where they were before. Bottom line here, they are talking about the easy money being behind us. It's not about growth at all costs anymore. It is about efficiency. And on that front, they talk about artificial intelligence, automation, sort of companies moving forward with efficiency more in mind, which is why they think that there could be more of a leg up.
Yeah, certainly. I thought that was a pretty interesting commentary, just given the fact of what we have seen play out this past earnings season and what this signals about what could be ahead here for the rest of the earnings season ahead this year. When you mentioned the fact that they had the 4,000 target before this, where we are today is right around 4,200. So it's not a lot of upside in terms of that 4,300 price target from where things are trading today. When you take into account the view out here from the street, certainly, though, Bank of America more bullish than some of its counterparts out there, because Morgan Stanley was out today reiterating the fact that they see some downside risk ahead, given the fact that some of this bad news maybe has not been priced into the market, the exact opposite of what we're hearing from Bank of America today. It was also interesting. They relied on 5 indicators here: fair value, sentiment positioning, central bank impact, long-term valuation, and also price momentum. I go back to that sentiment and positioning there because it seems like investor sentiment has been improving just a bit. The economic data has remained strong. Whether or not, though, that will continue, given the fact that we have the debt ceiling negotiations still going on down in D.C. We're rapidly approaching that X date. And then, of course, all eyes ahead to the next Fed meeting. If they raise rates, that's going to take the market by surprise, Akiko.
Yeah, rapidly approaching. Shauna, we are specifically 10 days out from the X date, and you have to wonder how much of that has really dampened the mood in the markets. To what extent are we likely to see more upside if there is some kind of resolution that comes out of D.C.? Now, deciphering that BofA note a little more, they talk specifically about being bullish on equal-weighted S&P, not necessarily cap-weighted. And there's 5 specific things they point to: concentration risk, valuation discount, duration risk, and then upside based on analyst price targets. So, sort of where we've been seeing the market move, but interesting to see that, given there's still questions around where the Fed policy is going to go. Even if we get a pause, how much higher can rates potentially go even after that pause? That's still the question that we're going to be talking about for weeks now.
We certainly will be. All right, let's get to it here. President Biden returning from the G7 summit and is expected to meet with House Speaker Kevin McCarthy later this evening for more on the latest with the debt ceiling dilemma. We want to bring in Jim Karen, Morgan Stanley Investment Management Fixed Income Portfolio Manager. Jim, it's great to see you here. So when it comes to the debt ceiling, markets still shrugging off the risk as we get closer and closer. Like Akiko said, 10 days until that X date. Why do you think that is? And how do you see that, I guess, factoring into some of these talks?
Well, first of all, I think it's very hard to predict anything that's actually taking place in Washington, D.C. behind closed doors. And I think for many of us, we're all really just trying to make our best guess at this. So the way that we see this, our base case is that there is going to be a deal that gets done because the alternative would just be so much worse. But ultimately, what I also think that the market has to focus on is what happens after the deal gets done. And people are going to start then talking about fiscal tightening, which isn't necessarily a good thing because it's going to come alongside of monetary policy tightening. So in the near term, I'd say that some of the health in the market is a case of buy the rumor. And I'm wondering if it turns into a sell the news once, as I said in our base case, that we get through a debt ceiling agreement, that becomes the fallout later on.
You know, Jim, it's starting to feel like a broken record here where we keep saying, yeah, the U.S. isn't going to default on its debt, but the risk of that alone is certainly significant. Now, you're a fixed income guy. When you think about what this means for the Treasury market, I mean, what kind of disruption are you bracing for?
Well, look, I mean, if it were to happen, clearly we saw this back in 2011. This is going to have a very, very big impact on collateral and repo markets. It's going to have a very big impact on T-bill markets. Some bills that are due to mature may not get paid out. That's a risk, right? That's something that we have to worry about. And what we also have to recognize is that the basic cost of capital starts with these short-term interest rate and these short-term interest rate instruments. So what this ends up doing is it creates a cascading effect of increasing risk premia across all of the broader asset class sectors, whether that's credit or whether that's equity or high yield or anything else. So it's really hard to prepare and brace for this because there's no real specific instrument that you can really hedge in a meaningful way to hedge your entire portfolio. So we're really vulnerable to what gets decided in Washington, I'm sad to say.
And to that point that you just made in your first answer here, let's say there is a resolution, you say then we brace for fiscal tightening. What does that mean from your perspective?
So that's where I think things get really interesting, right? Because first of all, the economy is slowing down. That we know. We know it's not slowing as much as people thought. And remember, even though the markets are doing well, the markets are not the economy. So there is an economic slowdown that's taking place. And I'm wondering if the blame game then starts to get played in Washington, as it so often does, that if we start to get some declining economic data, that gets tied in together with some of the fiscal tightening, that creates a narrative that gains momentum, that creates some negative sentiment in the marketplace, just broadly speaking. So that's something that I think we need to worry about. Now, having said all that, a lot of the fiscal spending that was being done, this goes back to the American Rescue Plan, the infrastructure plan, and all the things that are being debated in the debt ceiling debate today, much of that, by most economists' measures, didn't create a lot of stimulus in the first place. So this could just all be a war of narratives between both political parties. But I think the sentiment in the market really takes a toll on this. And there again, it could increase the risk premium. It just makes the markets a little bit more treacherous to navigate once we get through the debt ceiling. Now, clearly we have to get through the debt ceiling. But once that happens, I think that we still are going to be debating a lot of different things.
Yeah, and Jim, one of the things that is being debated, has been debated on the street for quite some time, is Fed policy and what needs to happen next. We heard from St. Louis Fed President here, Bullard, earlier today, advocating for the fact that we still need higher rates. He thinks that 2 more hikes may be necessary this year. Is that going too far?
So I mean, my personal view is that it is. But now look, this is a clear debate between those who believe that 500 basis points of rate hikes, that there's going to be lagged effects of those 500 basis points of rate hikes that's yet to hit the economy, versus those thinking that even those lagged effects won't be enough to cure inflation. Now, I get the argument that if we end up having a resurgence of inflation, that if inflation becomes unanchored later on and the Fed doesn't do enough today to prevent inflation becoming unanchored, that could be much, much worse. And I think that's where Bullard and Kashkari are coming down. But then you've got Mary Daly, you've got Bostic on the other side of this, essentially saying that, look, I think that at this point, we have to wait and see. We've done 500 basis points. We've had some turmoil in the banking sector. Does more rate hikes, does that actually solve the problem? Or is it really just a question of time? Do we just need to be a little bit more patient? And I come down on the Mary Daly Bostic side of the argument and a little bit less on the Kashkari side and the Bullard side, which seems to be much more immediately hawkish.
So what does that mean from an investment standpoint?
So the way that I see it is that from a default risk perspective, I would argue that credit spreads actually look reasonably attractive. So my base case is that we do not see a hard landing. If that's the case, then high yield looks reasonably attractive. U.S. housing-related securities, non-agency mortgages look reasonably attractive at this point. If we don't have a hard landing, I think that the credit risk default premium doesn't necessarily get realized, and essentially it's good for an investor to capture that. So it's not that spreads are particularly wide, but I think that the all-in yield for bond investors today looking at high yield or even investment grade is actually reasonably attractive. The only time it's not attractive is if we end up going into a hard landing and have a deep recession and have default risks spike. So if the Fed is on hold, and this is what my view is, that there's going to be a big pause, this is going to be reasonably friendly for the credit markets. This is going to be good for fixed income markets, and essentially, I think it can create a good investment opportunity to look at some of these high yields that are yielding somewhere around 7.5% or 8%, or some investment grade yields that are yielding somewhere around 5.25%. These are reasonable yields of potential returns that one could get by the end of the year, and I think this is looking pretty interesting right now.
So, Jim, when investors, you say it's critical here to make sure that your portfolio is balanced rather than just defensive. Why do you think a time like it's so important to do just that? And as investors are trying to evaluate some opportunities outside what you were just talking about with high yield, where do you see that?
Yeah, so I'm glad you asked that question because, look, I mean, one of the things I think the market's missed this entire year is that the risks in the market are more balanced than what the consensus negative narrative would have us believe. So many people, forecasters in the market, are quite negative and they're quite pessimistic at the moment. And my personal view is that the risks are a whole lot more balanced, meaning that if risk on is a risk, just like any other risk, it needs to be hedged. So let's not try to convince somebody to be bullish in these markets, but let's at least convince people to understand that there is potential and possible upside. And I think that's been true all year. So if you select a defensive style in your portfolio, you are basically forecasting an economic outcome, which is a negative outcome, and you're trying to position for that outcome. Rather than position for one specific outcome, why not position for either outcome and just have a diversified portfolio and say, look, if good things happen, this part of my portfolio does well. And if not so good things happen, then this part of my portfolio should make up for the shortcomings. And that's the way that we've been thinking about it in our global balanced funds and strategies, is that we've really been thinking about this as more of a balanced risk market as opposed to just grabbing on to the bearish consensus narrative and trying to position for that.
So balanced risk. Outside of the U.S., you see any other opportunities?
Look, Europe. I mean, Europe's been doing really well. European equity markets are up between 12 and 15%. Much of the European equity market is really a value story, right? So the value markets within the European side look reasonably still look reasonably attractive, and they've had a pretty good run. There's been some great opportunities within Greece. You know, Greece recently had elections, and it seems to have more of an investment-friendly result, and they might go from a high yield or sub-investment grade entity to investment grade. So there could be I think there's a lot of positive momentum that's still within the Eurozone. It doesn't mean that economic conditions aren't going to slow. I mean, the central banks there are hiking. It's just that I think that the sentiment indicators right now has kept people and money on the sidelines such that they're missing a lot of the rally that's in the marketplace, and they may be forced in as conditions don't deteriorate as much as they thought that they might. So I think that's the other timeline that we have to worry about, is a lot of the negative sentiment is starting to run out of time, right? It was supposed to happen already. We were already supposed to have a bad first half of the year. That hasn't materialized. So therefore, how much more time do we need to give it? Now I'm hearing that the recession might be in 2024, not in 2023. Well, what do you tell investors who are expecting some performance in 2023? Oh, sorry, let's wait and let's do it again. So this is what we have to really be worried about. That's why we like a balanced strategy.
Yeah, certainly a tough market to navigate. Thankfully, we've got some takeaways from you there, Jim Caron, Morgan Stanley Investment Management Fixed Income Portfolio Manager. Appreciate your time today. Well, we are just getting started here on Yahoo Finance Live. Coming up, we have a new candidate for the 2024 presidential election. We're going to break down just who is backing South Carolina Senator Tim Scott and what this means for the rest of the Republican Party. Plus, we are joined by the CFO of Ford as the company unveils some new EV plans at their latest Capital Markets Day. And Meta hit with a $1 billion fine from the EU today. We're going to discuss what this means for the tech giant's footprint in the European market later in this show. Stick around.
Foot Locker shares sinking for the second trading day in a row over the past 5 days. You're looking at losses of just about 30%. Now, the company reported weaker than expected a full year profit guidance last week. But this might not be just a Foot Locker problem. Yahoo Finance's Josh Schaefer is here to explain who else could be at risk here. And maybe it's a sector-wide issue when it comes to a pair athletic footwear.
Yeah, Shauna. So I want to talk about Nike today. And really what you're looking at with Nike is there's sort of two things. There's the relationship to Foot Locker, and then there's the overall sector and what could be happening. But when we start with what's happening at Foot Locker, you take a look at Foot Locker sales have dropped over the last several quarters now, or sorry, not the last several quarters, but same store sales over the last several quarters have sort of been dwindling, weak again this quarter. And what you're really looking at there is just a general slowdown. They're calling it a tough macroeconomic backdrop. But where that relates to Nike is Nike represents about 70% of Foot Locker's overall sales. So Foot Locker is seeing less sales. They're probably selling less Nikes too. Wedbush pointing out in their note today that Nike actually Nike was a significant down draw. So what they saw was non-Nike sales increased. Wedbush then took that to mean that Nike sales probably decreased in about the mid-teen range. And what's going to happen here is Foot Locker is saying that they still have too much inventory, right? Foot Locker still, inventory is up 25% year over year. They want to offload that. Well, those are going to be Nike shoes that they're not going to buy then, right? Because they're still selling those shoes. And I think what people are worried about here is what that means for Nike overall in Nike's business. are people just going to be buying less shoes as we see that consumer discretionary slowdown?
Yeah, what do you make of the inventory picture here this earnings season? Because we had seen for so many consecutive quarters that retailers across the board were really struggling with their inventory levels. Some of these retailers have been able to get it under control when you take into account what we heard from Target last week, Walmart, TJX. But when it comes to this side of the business, why do you think they're having a much tougher time? Did they not promote? Do they not have those types of markdowns that we were seeing maybe at some of the other retailers?
I think you have seen markdowns, and like you said, so the big box retailers, there's a great story up on Yahoo Finance right now on those and the inventory problems that they're not seeing. But what you're seeing with the retailer or with the athletic retailers is sales are just down, right? They were the biggest laggard in retail sales last month. People are not buying that second or third pair of shoes. And when you talk about a broader promotional environment, something that an analyst pointed out today with Nike, other websites like a StockX that sells Nike shoes on a secondary level are now selling them cheaper than Nike sells them. Nike is now marking down shoes that are very popular. Talk about the Air Max 90s, Air Max 95s. Nike has sold those shoes for over $100 for years. Some of those now, you go on Nike's websites, there's a lot of shoes for under $100. So I think the environment is actually maybe over promotional in some ways, and then you become competitive against yourself if you're Nike when your shoes are out there on the secondary market for cheaper than you're trying to sell them on your website. It's hard to offload that.
Yeah, extremely challenging environment. I was actually shopping for Nikes this weekend and looking for those deals, so maybe more ahead. All right, Josh Schaefer, thanks so much.
Well, major indices are trading pretty flat about 40 minutes before the closing bell. We're going to be taking stock of your portfolio with Robert Schein, Blanky Schein Wealth Management Chief Investment Officer. And Rob, you've got some stock picks for us, also some names you want people to steer clear of. But let's start with your top picks. And we're going to kick off with this one, Invesco Aerospace and Defense ETF. The ticker is PPA. You say there's a lot of tailwinds here working for this one.
Yeah, if you look at defense year to date, it's almost been a laggard. Obviously, large cap growth is leading on all indices. And in a market like this, we always like to look for value and specifically who hasn't participated. While it's up year to date, we believe it has room to run. Obviously, the debt ceiling right now is in full debate, whether the $842 billion in proposed for defense budget by the U.S. Continues. But hey, look, around the world, geopolitically, there's a lot of tensions. So we believe be defensive with your portfolios, be diversified. But one way to do that is the PPA. It's the aerospace and defense. It's a diversified approach to adding defense to your portfolio for that reason.
One of the other picks that you have here is you like where gold is trading at right now. You specifically like GLD. Why do you see more upside with gold prices, which have already had a strong start to the year?
Yeah, gold's one of those where if you go back and look at the analogs of 2011, when we had the debt ceiling debate, post that we had equity markets sell off. We also saw a bid, gold caught a bid. We believe we could see a lot of that playing out. Equity markets are obviously just trading flat right now the last couple of days as we get closer to the debt ceiling. And I think post-debt ceiling, whatever happens, equity markets will then trade ultimately maybe negatively on the news. So therefore, gold, add some gold in your portfolio. We believe it's under-owned and it's a great diversifier, especially in an inflationary environment. And it actually does perform very well over the long term.
Robert, one ticker you're staying away from, KRE, and this is one that we have heard from other guests as well. This is the regional banking ETF. When you look at what has led up to where we are today over the last several months, the stress that we've seen in the regional banking system, have we seen the worst of it?
Well, if I look at our practice here and just watch consumer behaviors, we don't believe that the small regional banks, and that's what this is an ETF that basically is a diversified approach to own small regional banks. If you like that exposure, we believe it's way too risky. So we're not a fan of this, so we would stay away from it. But like I said, if you look at our little practice here, we've seen millions of dollars just right across the street from the small regional banks year to date come into Blanky Schein Wealth Management, about $25 million just for the first half of this year, simply because people are leaving those banks and they're seeking safe haven. And so we believe that could continue. There's potentially one or two more banks out there that might need some support and some assistance. And so that's why we'd be cautious of this indices.
Another pick that you don't like is the Russell 2000. Some of those small caps, they've actually been doing decent here over the last week or so. But why do you think that short little pop is going to be short-lived?
Well, they've underperformed year to date, and like anything, the small banks, or excuse me, the small companies, if you will, in this case, don't perform if you're going into a recession. So if we have a slower economy, less liquidity, more austerity post the debt ceiling in terms of spending, and then the lending, right? That we just talked about the regional banks, the lending is going to be more restrictive all across the board. That doesn't really set up too well for the Russell or even small caps particularly. There is a time and place to own them, but not when you have a recession looming overhead and there's a lot of clouds on the horizon. So small caps, you want to stick with large caps over small caps. There will be a time to own them, but right now, just be more defensive in your portfolio.
All right, Robert Schein, we're going to leave it there. Thanks so much.
Thank you.
Well, coming up, we are going to be joined by the CFO of Ford after the automaker unveiled its latest EV plans. John Lawler will join us after the break.
Well, Apple's shares are under a bit of pressure today on the heels of a downgrade. Yahoo Finance contributor Remy Blair is at the New York Stock Exchange with the details. Remy, the note specifically highlights some future shipment targets and the risk there. What's the concern?
Well, indeed, as you just mentioned, we're here at the beginning of the trading week, and Apple shares may be slightly below the flat line, but heading into the close, they are only slightly lower on the session. And Apple did get a rare downgrade. This did come as Loop Capital downgraded Apple to hold from buy, but reiterated its price target unchanged at $180. Now, the firm did cite risk to Apple's top line in the June quarter, and this came as analysts and Barua cited concerns that Apple may not be able to deliver on its revenue guidance for the June quarter as Apple reduces its build as well as shipment forecasts. Now, the Loop Capital's supply chain analyst John Donovan says that Apple is reducing its June quarter iPhone builds and shipments by about 10% in the last 6 weeks. We need to keep in mind that overall Apple shares do remain elevated well over 30% year to date, and that means millions of dollars in capital have been added just this year alone. In its latest earnings report, Apple announced a 3% quarterly revenue decline year over year as Mac sales fell, but Mac services did grow to an all-time high. And as we keep an eye on Apple shares for the rest of this week, prices do remain elevated, and Apple is edging closer to that lofty market valuation of $3 trillion US. In January 2022, Apple stock hit an all-time high, with the split-adjusted stock seeing a high of $182.94 and an all-time closing high of $180.43 on January 3rd of last year. But Apple has yet to close at that $3 trillion market cap. The company is one of the big tech names that have been pushing the Nasdaq 100 higher this year ahead of the major equity averages. Now, overall, while returns may not be as massive for Apple going forward, given macro headwinds, the company's balance sheet does remain firm, and Apple may still have room to grow.
Remy Blair from the floor of the New York Stock Exchange. Thanks so much for that.
Jamie Dimon is back in the spotlight amid JP Morgan's Investor Day today. Now, this comes after the company made a move to grow its dominance in the banking space, taking over First Republic. JP Morgan today raising its 2023 revenue target to $84 billion. Here with the latest is David Hollerith. David, I know you have been listening in, following this Investor Day all day. There's certainly been some discussion surrounding the succession plan for CEO Jamie Dimon. What are we learning?
Yeah, not a ton new. I think we would say after about 6 hours of in presentations to investors from leading executives at JP Morgan, Jamie Dimon came out and answered questions. He walked out to the Rocky theme song just to sort of give you a vibe, in an open shirt, no tie. And, I think the feel of it, besides the fact that JP Morgan is doing exceedingly well in a time that's been a lot tougher for, smaller banks, I think the theme of this, too, is especially given last week with Morgan Stanley's CEO, James Gorman, stepping down, that it's only a matter of time before Dimon announces his succession plans. And, the running joke has been that he'll stay on for another 5 years. And he's been saying that for more than 5 years ago. So, I think everybody's sort of waiting for him to give some sort of resignation, and he wouldn't do that today. But, one thing he did say is he said, I can't do this forever. And I know that. And he said that when he loses the intensity to do the job, and I'm paraphrasing here, that's when he'll know to call it quits. And so that, is a little bit more color in terms of what he's thinking. The other side of this is obviously who his successor would be. We're fairly certain at this point it would be someone internal at JP Morgan. And, the co-heads of the consumer bank division, Marianne Lake and Jennifer Piepszak, are both two names that come up a lot. But he would not touch on anyone in particular, or even as opposed to Morgan Stanley last week, would say how many names are in the running to take that role. But he did highlight that he's not looking at all in terms of a specific area of focus the CEO needs to have. He said that several times he brought up that essentially courage and grit are the most important things to lead, and that's what he'll be looking for. Now, if we just take a step back, though, I think that a lot of this comes down to the fact that he's been such a big presence for the bank. And, I think we could even zoom out and say the U.S. banking sector, that the idea of him stepping down is a little bit of an existential concern at this point. But that's all we have today.
David Hollerith, I've got the Rocky theme song stuck in my head now. Thanks so much for that, giving us the latest.
Investors are increasingly on edge as the U.S. gets closer and closer to being unable to pay its bills. If the U.S. does default, it could wreak havoc on the markets and the economy. Here to tell us more is Mark Zandi, the chief economist at Moody's Analytics. Mark, it's great to see you again. So we are getting closer and closer and closer to that X date. Talk to us about, one, how much is on the line here and how likely it is that you think we will see a breach.
Oh boy. Well, the probability is non-zero, and it's rising. I mean, if you said to me, "Hey, Mark, give me a number," I'd say probably 1 in 10 at this point that we would breach. A lot's on the line with each passing day. I suspect that if we get to the other side of Memorial Day and there's no agreement and the rhetoric is still pretty dark, I think that's when markets will start reflecting that. If we get to the X date, and I think the X date is probably June 8th, not June 1, but we get to the X date and we breach, then I think that'll be very chaotic. Markets will be down. It'll be a mess.
Has that risk elevated given what we've heard or developed over the last several days? I mean, the president coming back from Japan, obviously we know he's meeting with the House Speaker today. It feels like the urgency has been upped, partly because we are 10 days out, but because we just haven't seen a whole lot of promise.
Well, this is, in one respect, this is what you would expect to happen, right? I mean, because this is exactly the script that lawmakers have taken in the past. There's a lot of drama, Sturm und Drang, a lot of dark rhetoric, some signs of hope, take it right down to the wire, and then pass a piece of legislation increasing the debt limit. So in that regard, this feels like it's going down the same path. But, there are a lot of differences between now and other episodes, debt limit drama episodes, mostly around our politics. I mean, our politics are much more vexed, much more divided. And of course, Speaker McCarthy's in a pretty difficult spot. He's got to come up with a piece of legislation that his caucus is going to be willing to sign on to. And that's going to be pretty tough to do. And if he doesn't do it, he may not therefore put any kind of legislation increasing the debt limit up for a vote. And if he can't put it up for a vote, then of course the odds of us breaching are very high. So this just feels different than other debt limit dramas and therefore more angst, and thus the high probability I attach to a breach.
Yeah, Mark, you broke down some different scenarios here, what we're looking at if we see a short-term breach versus a prolonged breach. When it comes to that short-term breach, what is that? You mentioned the fact that the markets are going to start reacting. Obviously, we could see a massive pullback. What does it mean for the economy, for unemployment, and why everyday Americans should care?
Yeah, I think if we breach, I think we go into recession. I mean, because the economy is already very fragile. Most economists, not me, but most economists think we're going into recession even without this debt limit drama or breach. So, we're right on the precipice as it is. And then you throw this into the mix, it's going to be pretty hard, I think, for people to kind of get by this without them pulling back on their spending and investment and hiring and the recession occurring. So I think in all likelihood, if we breach for any length of time, we're going into recession. The other thing I'd say is it will also mean higher interest rates probably forever until we get rid of this debt limit law altogether, because investors are going to say to themselves, well, what about next time and the time after that and the time after that? If you guys were willing to breach this go around, what makes me think you're not going to do that again? And next time I might not get paid as an investor. So interest rates will be higher. So it's not only a problem in terms of the near term in recession, but it's also what it means for the longer term, higher interest rates, which are corrosive on the economy.
Mark, there's one scenario that keeps getting thrown around by Democrats, and that is specifically invoking the 14th Amendment. I'm looking through some of your tweets to see how you view that. I mean, it sounds like you think it's a process that makes sense, but not necessarily one that we're likely to see. I mean, can you walk me through your thinking there and why that's getting pushed so much by the Democrats?
Yeah, it's kind of intoxicating, isn't it? I mean, if you do invoke the 14th Amendment and the Supreme Court upholds its constitutionality, you've just gotten rid of the debt limit forever, and you solve that problem. So that that's why I think people kind of go back to that as a possible solution. But it's going to be very painful. I mean, because as soon as the president invokes the 14th Amendment, until the time the Supreme Court opines on it, there's going to be very chaotic, because investors are going to wonder, will the bonds issued during that period be full faith and credit? Will they be, treasury bonds with no credit risk? And that's a reasonable question. And then, of course, there's the question of, well, how's the Supreme Court actually going to rule on this? Because you've got constitutional scholars on both sides, one arguing, yeah, the Supreme Court will say it's fine, another was saying it's not. Hard to know. I mean, obviously I'm not a constitutional lawyer, but I like to play one. I mean, my own thought is, can it possibly be constitutional that the government doesn't pay its bills? How can that possibly be? But, the legal system and the Supreme Court may decide something different. So a lot of uncertainty around it. So it's not, you wouldn't want to do this unless things were really going off the rails. It didn't look like you were going to come to any agreement. You're going to be in this prolonged breach scenario with a very severe recession deadhead, and then it's a Hobson's choice. What's the least bad choice here? I'll take the one with the 14th Amendment, because maybe at the end of the day, we solve this problem once and for all.
Mark, the showdown in D.C. is happening at a time when the economy is already slowing. Investors are really focusing on Fed policy, what we'll likely see in June. We've got recent commentary here from Powell within the last couple of days, Kashkari this morning, saying that maybe it does make sense to pause, something that you've been advocating for now for quite some time. Why are you so convinced that now's the right time and we need to pause?
Oh, well, let me name the ways. I mean, look, the economy is slowing. That's pretty clear. Inflation is moderating, and I can state with increasing confidence, just given the arithmetic here, that it's going to continue to moderate. The banking system is very fragile. We're in the middle of this debt limit battle. A lot of angst around that. And I have a sense this is going to play out over a period of time. It's not going to go away, quickly. So you kind of add this all up and you say, okay, well, I've raised rates from 0 to over 5% in about a year. Maybe I should just stop, take a look around, and see what kind of effect that's going to have on the economy, the banking system, and everything else. And I think what they're going to find is that, they're going to get what they need. They're going to get an economy that's growing slowly, wage pressures moderating, inflation coming back to target, and an economy that's sticking to the script that they want. So I think there's a lot of reasons for them to say, hey, let's just take a pause here. And I should say, I think Kashkari said it. It can be a pause. I mean, it doesn't mean that this is the terminal rate. If I'm wrong and inflation remains more persistent and more of a problem, they can start resuming interest rates again down the road. And I don't think no harm, no foul at that point.
Yeah, we heard him say the option can't be off the table, at least for another rate hike. Mark Zandi, as always, appreciate your insight today. Chief Economist for Moody's Analytics.
Thank you.
Ford's Capital Markets Day kicking off in Michigan, featuring updates on the company's strategy as it looks to redefine customer value and achieve new financial targets. Pras Subramanian joins us now live from the event with Ford CFO John Lawler. Pras.
Hey, thanks, Shauna. So yeah, a lot going on today, talking about profitability, mining and resources, things like that. But so let's talk to John Lawler, CFO here, who's joining me today. From your point of view, big picture stuff here, what should investors focus on from a profitability point of view?
Well, I think what they should understand is that we have three incredible businesses buried within Ford Motor Company. We have our Ford Blue business, which is our internal combustion engine business, iconic brands like Broncos, Raptors, F-Series, really strong nameplates, Mustang. Then you also have a startup business with our Model E business, which is electrification. It's BEVs. It's electric vehicles. And then you have what we call our secret weapon, our commercial business in Ford Pro, which has incredible market share penetration and is also a services as well as a hardware platform vehicle company.
So that Model E electric vehicle business right now, not profitable, but by 2026, you guys want to hit that 8% EBIT margin. I think some on Wall Street are skeptical on that. What do you want to say to them about that?
Well, I would say that we have an incredible team. And it first starts with talent. You've often heard people say, You bet on the team. Well, we have some of the best in the industry. The people leading our electric vehicle team, they've done it before, right? They've created profitable EVs. And if investors today, if they watch this, what we did, they'll see that our approach is uniquely different and is about low complexity. It's about really giving the consumers what they need. It's about efficiency at every turn. And that's the secret formula to create profitable EVs. And that's what we're executing with our Gen 2 vehicles.
Right. So the Gen 2 vehicles. Now, what's the secret sauce behind that? What's going to make drive those costs down for EVs?
Well, there's three key levers. There's scale, of course, as we grow. And then there is the clean sheet design. It's a clean sheet design in that we can start with a very simplified, low complexity architecture where we can optimize for cost. And then, of course, it's optimizing batteries. Efficiency in your design to get the smallest battery for the longest distance. And it's also about chemistries and battery efficiency.
So talking about batteries, a few big deals today announced by the company. I know that's not your area of the business, but what does it tell you from a cost point of view about driving down those costs for the EVs?
Well, one of the key elements of the cost reductions is vertical integration. And so now we're vertically integrating all the way down to the mines to get the minerals that we need to produce the batteries for these vehicles. And we announced 3 key relationships today with us going straight into the mines, and that's going to allow us then to be compliant for all of the IRA benefits that are out there.
And I know that the mining with the materials is you're trying to not be in places like China so much these days, even though right now most industry is reliant on Chinese resources. So speaking of China, Ford sort of cutting costs there. You saw the JV in operation, that joint venture. Is China still a strategic point of view for Ford? Are you looking at China as not so much a business venture anymore?
Well, we're restructuring our business in China, and we know the playbook. We've done it in India, we've done it in South America. We know what we need to do: asset light, rely on our partners, make sure that we're getting a return on our invested capital. So we're going to take the same playbook that's been successful elsewhere around the world.
So last question here. I want to talk to you about customers. Higher prices are sort of the norm here, higher finance payments. What are customers telling you for, not just for, the high margin derivative vehicles like the Raptors and things like that, but also just the regular F-150s, the regular Escapes, things like that? What are they saying to you?
Well, we've been pretty consistent in saying that we believe as we go through the second half of this year into next year, you're going to see prices normalize. You're going to see them come down as supply and demand come back into balance. Plus, there's a bit of an affordability issue there in that, we look at income to payment ratios, and that's increased over the last couple of years. And we think that'll go back to more of the normal run rate before COVID, and that's going to happen over the next 18 to 24 months.
So potentially more cars, lower payments, hopefully, people, and more options for those middle American customers. John Lawler, thanks so much. Akiko, back over to you.
All right, Prasi remaining on the ground for us there, and our thanks to Ford CFO John Lawler. Well, still to come, an oral drug from Pfizer may work quicker for weight loss. More on that when Yahoo Finance returns. A full peer-reviewed study suggests an oral drug from Pfizer may work quicker for weight loss and as effective as Novo Nordisk's Ozempic injection. We have Yahoo Finance's Rochelle Kufo here more on this clinical trial and the results here providing a big pop for Pfizer stock today.
And we know that these weight loss medications and treatments are all the rage. So as you mentioned, this full peer-reviewed study of the clinical trial of Pfizer's danuglipron, that treatment is out, showing that the potential for a faster path to weight loss than the current treatments using diabetes drugs to treat obesity. Now, Pfizer stock rising as participants were able to lose about 10 pounds over the course of 16 weeks versus 9.9 pounds over the course of 30 weeks with Novo Nordisk's current treatment, Ozempic, aka Wegovy. Of course, a lot of people know that was used by Elon Musk. But note the different dosage levels as well. Another key difference is that danuglipron is an oral pill versus weekly injections with Ozempic, because obviously that's something that can be off-putting for people. Now, the phase 2 trial of danuglipron followed 411 adults with type 2 diabetes who either took the drug twice a day or a placebo. Now, both of these treatments, danuglipron and Ozempic, they mimic the GLP-1 hormone in the gut. That's the hormone that tells us when the brain is telling us that we're full. Side effects, though, also related to the gut mostly: nausea, vomiting, abdominal discomfort, diarrhea, and headaches. But it's worth noting that this is a bigger randomized controlled trial than was used in phase 1. That followed 37 patients, and that also means that these trial participants are randomly selected to receive the treatment or the placebo, which also helps introduce less bias as well. And of course, we have to mention Eli Lilly, already in this space at the moment with an injectable called Mounjaro. They're seeking FDA approval, potentially some reports saying might come by the end of this year or potentially beginning of next year. But a reminder, of course, the obesity reduction aspect, this is off-label use. These are diabetes drugs, and Wegovy is the only FDA-approved treatment out of these so far for chronic weight management. Now, of course, this isn't just supposed to be, some sort of magic pill or magic shot here. This is supposed to be used with a reduced calorie meal plan as well as increased physical activity. So worth keeping that in mind. There are no shortcuts when it comes to overall health, guys.
Certainly not, but we're seeing investors excited about this with shares popping today up just about 5%. Rochelle, thanks. Let's take a look at Meta, because the company hit with a huge fine from the EU, a record $1.3 billion over the transferring of European user data to the U.S. Now, the crackdown also includes a deadline after regulators said that it failed to protect personal information from the American security services here. It's not having much of an impact on the stock today, but of course, Akiko, this points to a larger discussion here, just the implications of this fine, what it not only means for Meta, but what it means for the broader tech players, a number of companies as well.
Yeah, not seeing a whole lot of stock move there. We've come to learn that with regulation, these things don't really swing the stock in a significant way, because the expectation is that this is a very long conversation, or a conversation that's going to happen over a very long period of time. Important to note, though, when you look at what happened today, I mean, this shows that the EU is really starting to step up enforcement of GDPR. And remember, that has been in effect for about 5 years now. Certainly, when you think about the fine itself, yes, it's a lot of money. Is it significant for Meta overall? Well, not monetarily, maybe, but the reality is this points to the fact that Meta, at least the ruling from the EU is that they have not been securing that data from European users, which their ruling essentially says you can't freely send the information across the Atlantic because there is concern about that data being accessed by American spy agencies. At least that's how the Europeans describe it. So, Shauna, it's interesting to me in the context of so many countries, in the case of the EU, really stepping up data collection. And that's something the U.S. has been doing as well. But this is just one example of how we're starting to see these lines get divided.
Yeah, we know Europe, the EU has certainly been one of the leaders here in this space, just in terms of the crackdown of these tech giants. When it comes to the pressure, though, that the U.S. now faces, and you're better to speak to this than I am, just in terms of the pressure, mounting pressure that the U.S. government faces in order to reach that deal, and also just the significance, the fact that this was a $1.3 billion fine. What signal do you think that this sends kind of to those other players out there? Yes, it's not huge for Meta, but for a smaller company, a massive fine like this could be devastating.
Yeah, well, you can bet that these big tech companies are definitely amping up the pressure to the U.S. government to sign some kind of deal between the U.S. and the EU about data sharing, because the reality is, because those guardrails haven't been established, the EU has been leading the conversation on this. Today is just yet another example. But, Shauna, worth discussing that this is kind of, again, another example of how data has really become the heart of concerns around national security. We've seen it here in the U.S. with data collection concerns around TikTok. We've seen it in other countries as well. And you can bet that is going to only become a bigger issue because of all that data that's collected. And the reality is, it's a tough thing to enforce because, as you know, in the internet, when you're talking about data being stored, it's very hard to put up those walls between countries, between regions.
Yeah, certainly. And there was an analyst quoted here in a journal piece saying that the next few months are going to be very critical here when it comes to the debate around data and exactly what that looks like for many, many companies. All right, well, coming up next, we are counting down to the closing bell. Again, a bit of a mixed picture. The Dow now off 132 points. We'll be right back.
We are just seconds away from the closing bell. Let's do a final check of the markets here with the Dow down 145 points, the S&P 500 trading pretty flat, and the Nasdaq up 61.
That does it for today's trading day. Again, the Dow closing in the red, S&P and Nasdaq holding on to gains. The Nasdaq closing off its highs of the day, off just about 0.5%. You take a look at the sector action here. Communication services, the outperformer today, as well as real estate. In terms of the laggard consumer staples, the XLP closing off just about 1.5%.
Well, investors on edge as the U.S. gets closer and closer to being unable to pay its bills. President Joe Biden returning from the G7 summit in Japan. He is expected to meet with House Speaker Kevin McCarthy later this evening. Now, if the U.S. does default, it could wreak havoc on the markets and the economy. And Shana, we were saying earlier, 10 days is what we're looking at here from that earliest X date, at least how we've heard it from Treasury Secretary Janet Yellen. But every day that urgency does go up a bit, even if the probability of a full-on default markets aren't necessarily expecting, it's the risk of that is only going to add to the jitters.
Yeah, it certainly will, and that's likely to play out here in the markets in the coming days. Now, lots to talk about that X date. We just heard from Moody's chief economist Mark Zandi in the last hour. He was saying that he thinks the X date is right around June 8th. In terms of the probability that we will, in fact, breach that date, he said it's about a 10% probability right now. But of course, you would think that those odds will continue to climb as we do get closer and closer to that X date. We have a very important meeting expected to take place this afternoon between President Biden and House Speaker Kevin McCarthy. Lots of talk about how much progress, if any, is going to be made in those discussions. Kevin McCarthy saying that he thinks progress needs to be made at this point here. But at least for now, the markets don't seem too worried about what is playing out down in D.C. We know traders have been closely watching it. But until we get very, very close, it seems like when we've been talking to a number of guests here over the last couple of weeks, until we get extremely close to that X date, markets will likely continue to shrug this off.
Yeah, I mean, the fact that both sides are talking is a good sign. But to our guests, to the point our guest made earlier today, it is about also looking at what happens after, if a deal is done, because that's going to lead to further fiscal tightening. All right, shares of DraftKings closing the day higher following an upgrade to buy over at UBS. The analyst citing higher revenue growth and points to the growing number of states that are legalizing online sports gambling. The stock price target was also raised from $19 to $30 a share. Shana, the analyst specifically saying that revenue could be growing at a compound annual growth rate of more than 20% from 2023 to 2026. I am curious, though, about the potential catalyst here, because we've talked about sports betting in the past, saying that, look, if you look at how many states are left to legalize and how big those markets are, they simply aren't the ones that we were looking at, like a New Jersey, like a New York. You have to wonder how many more catalysts there are to push things to the upside.
Yeah, and also, Kiko, the fact that there could likely be more competitors within this space. We talk a lot about FanDuel and DraftKings dominating this market right now, but Fanatics obviously getting into this space as well. You would think more companies potentially could chip away this market share here. But when it comes to the trading action today, we're looking at DraftKings at a 52-week high. One of the encouraging things that UBS did point to in this note here is that sales in existing states, that they're generating more revenue per player than they had been. Obviously a trend that is in favor here to DraftKings and potentially here to FanDuel. When we look across the space, more and more people spending more money on sports gambling obviously will help the industry grow here over the coming quarters. But again, over the last 2 years, you're still looking at losses of just over 40%. Right, a big story that we are following: U.S.-China tensions escalating after China's move to ban Micron. Now, shares of China's chip makers getting a boost on that headline. On Sunday, the Chinese government announced that companies handling sensitive information could not purchase microchips from U.S.-based company Micron. China's government alleging that the chips pose cybersecurity risks. Micron CFO Mark Murphy addressing the ban in a conference call this morning. Here's what he had to say.
We will continue to cooperate with the CAC and are working to understand the details about their security concerns with Micron products. We remain unclear as to what security concerns exist, and we've had no complaints from customers on the security of our products.
U.S. chip makers, a number of them under pressure today. Micron, one of the hardest hit there, closing off nearly 3%. We want to bring in Shahzad Kazi. He's China Beige Book International Managing Director. Shahzad, great to see you again. So this is just the latest in a series of tit-for-tat moves here between the U.S. and China. Is this just the beginning? And what does the next couple of months potentially look like?
Yeah, that's what everybody's asking now, right? In recent weeks, we've seen China really clamp down on a lot of foreign companies, and now this Micron decision comes out, which was somewhat expected. I think we need to remember that as far as the technology space is concerned, Beijing's ability to retaliate in a tit-for-tat manner is vastly more limited. So I think, the question is being asked, which companies come next? It may not necessarily be a tech company. It may just be a whole different industry that Beijing chooses to go after next when it retaliates to DC.
Yeah, Shahzad, on that point, you look at how the Biden administration has handled this. I mean, we're coming just a day off of the G7 wrapping up over in Japan, and we heard the world leaders talk about reducing their exposure to China. At the same time, the president saying we're going to move towards more of a thawing between these tensions with China. I mean, it feels like we're getting a bit of mixed messages. On the one hand, economic pressure through some of these, export controls, and yet they also want to try and keep the conversation going, right?
Yeah, I think what's going on is that conversations that perhaps would have taken place had it not been for, say, the balloon crisis saga, are being revived. And that's sort of being billed as a thawing of relationships, right? But the real question, of course, is what do the two sides really sit down and discuss? What is the point of negotiation or talking right now? And we'll see how much of it is substantive rather than just talking for the sake of talking.
You mentioned the fact, Shahzad, that foreign businesses across a number of industries should be worried. How do you see that affecting foreign investment in China?
Look, Beijing is sending pretty bad signals to foreign investors, and this is supposed to be the year where they attract foreign investment, according to the party leadership. So I think there's a lot of concern. As I said, executives are beginning to panic because there's a lack of clarity in terms of under what rules and protocols are certain companies being targeted and others being left alone. So bad news for foreign investors at the moment.
Shahzad, you mentioned that China is very limited in terms of the leverage they have, particularly around chips, because they are so reliant on chip makers, not just from the U.S., but from Europe as well. Do you have any insight on where their chip making ability stands right now? We know they have been investing significantly. We know China wants to ramp up domestic production. How close are they?
Look, they're not very close at all, but that's exactly what they want to do, is get to a place where they occupy the cutting edge technologies and the chips that today the United States has the ability to restrict China and the Chinese military from accessing. They want to get to a place where they are producing the inputs, they're producing the equipment, and so on and so forth. But that is going to take a long time. Now, they've announced a big fund to start putting money towards this, to investing in acquiring that type of technology. This is going to be an uphill battle, no doubt. But at the same time, I don't think anybody should convince themselves here in the U.S. That China will inevitably fail. It's very likely that they may succeed.
Shahzad, when it comes to China's recovery here, what that looks like, given the fact that we're expected a massive new wave of COVID cases, given the fact that foreign companies might be pulling out or reducing their investment within the country, how significantly is that going to delay that recovery timeline?
Yeah, there are lots of concerns now around the Chinese recovery. There was a lot of hype in the beginning about how quickly China could recover to begin with. That was misplaced. But now I think what you're getting is, some amounts of revenge spending coming back. The property market is doing all right, not great, of course. Manufacturing is looking like it's going to slow down in the second half of the year. So lots of headwinds are building up. Foreign investors getting scared off a little bit is only going to add to that pressure, even though it may not be necessarily integral to the recovery story this year anyway.
So how big of a hit is that likely to be on Chinese economy? I mean, let's say, what we've heard in terms of where things are moving, the activity is going to pick up going into the second half of the year. And yet you've got these foreign investors who are turning cautious. How big of a hit is that? Or will that be?
It's probably a far stronger impact next year and the year after, because this is a bit of a longer term play. And the real question has been, sure, you can get a great 2023, from China. The real thing is what happens next year? What happens the year after? 2023 may very well look like a head fake in a couple of years here. And for that story, foreign investors, being scared away or shooed away is not a good thing.
Shahzad Kazi, always great to get your perspective. A China Beige Book. Thanks so much. All right, coming up, Senator Tim Scott has announced that he is running for president. More on his announcement and what this means for former President Trump on the other side. South Carolina Senator Tim Scott announcing that he is running for president in 2024. Yahoo Finance's Rick Newman joining us now for more on that. Rick, the field's starting to look a little bit crowded. Lots of talk about whether or not DeSantis, when he's going to throw his hat in the ring. But what do you think this means here for the next year and a half and the future here of the GOP?
I think it's expected. We are definitely going to see a crowding field. Tim Scott has presidential ambitions. We've known this before. The party has kind of put him on a bit of a pedestal. He's delivered some of the important speeches, for example. He's got a compelling personal story, rags to riches. He's the only black Republican in the Senate. He's widely viewed as a nice guy, Reagan-esque conservative, and he's trying to run as an alternative to Donald Trump, obviously. Now, one thing he lacks that Trump has is name recognition. He's not famous, and that matters for a lot. I'm sure he's going to come out very low in the polls. Even Ron DeSantis, the Florida governor, who's been getting a lot of attention, and is probably going to declare his candidacy this week, is running significantly behind Trump. But, this is a volatile election for the Republicans. A lot can change, especially with Donald Trump facing increasing amounts of litigation and possible criminal charges and other kind of legal trouble during the next 6 to 12 months. So doesn't hurt to throw your hat in the ring. And, keep in mind that a lot of people who seem like also-rans in the presidential campaign end up as possibly as a vice presidential candidate or a cabinet secretary if the party wins. So I'm sure that's part of what Tim Scott's ambitions are here. Speaking of vice president, we haven't even mentioned Vice President Mike Pence, potential his run as well. It's certainly going to be a crowded field. But what does this all mean in terms of this push to get the big name backers, especially business leaders, at least on the GOP side? So Scott has one huge backer, and that is Larry Ellison, the founder of Oracle. And I think this is going to be a real interesting question: is who gets these big backers who tend to donate tens of millions of dollars and potentially, more than $100 million to a campaign. And that's often through the super PACs that campaign, that run ads and do other things on behalf of a chosen candidate. So Scott is, because of his role on committees in Congress, he has had campaign contributions from some high-profile people, such as Mark Rowan, who's the CEO of Apollo, Yahoo Finance's parent company, and some other, Ken Griffin, co-founder of Citadel, and some other big-name people like that. Now, that doesn't mean they're going to support him in the presidential campaign, because there are a lot of big donors who will support multiple congressional candidates because they're not competing with each other. But when it comes to a presidential campaign, they are all competing with each other. So basically, you have to choose one. So whether those guys will, some of those rich donors will end up choosing Scott, I don't know. An interesting guy to watch is Ken Griffin. He has been a big supporter of DeSantis up till now, but he has also expressed some concern about DeSantis and his anti-business tactics, as many people call them, with regard to Disney. So that would be interesting if Ken Griffin were to defect from DeSantis and start backing somebody else, because he's got deep pockets and a lot of money to donate.
All right, Rick Newman, certainly a busy several months ahead for you. Thanks so much.
Can't wait. Bye, guys.
Let's get to some breaking news in the tech space. TikTok filing a lawsuit against the state of Montana after the state's governor signed a TikTok ban into law last week. Let's bring in Yahoo Finance tech editor Dan Halley, who has the details. Dan, what specifically is TikTok alleging?
Yeah, so there's a number of things that TikTok is actually alleging here, essentially saying that this law just can't go forward. And let me just go through a few of them. They first point to the First Amendment, saying that this violates the rights of users, as well as TikTok's parent company. They also say federal preemption, stops Montana from trying to pass a law that has to do with national security. It also says that it violates the Constitution's Commerce Clause because it risks disrupting the flow of travel and commerce between states. And it also says that the bill is too broad and targets TikTok and not social media companies in general. Now, in response to, or as part of their statement, a TikTok spokesperson said, "We are challenging Montana's unconstitutional TikTok ban to protect our business and the hundreds of thousands of TikTok users in Montana. We believe our legal challenge will prevail based on an exceedingly strong set of precedents and facts." Now, I had previously spoken to a number of First Amendment experts who said that this law likely does violate the First Amendment. Some have said that this is just, as TikTok points out, too broad, that there's no specific harms alleged, that the Montana Governor Gianforte's statement that the company is sending data to the Chinese government is unfounded. There's no evidence as such. We still haven't seen that evidence from the federal government or Montana here. And so those are just some of the problems that they're running into. And also the experts that I spoke to had said, look, instead of doing something like this, there's an easier solution here rather than banning the app. Pass some kind of federal data privacy law, and that would protect users' data without having to cut them off from TikTok.
Yeah, it comes down to regulation. At least that's one of the arguments there. Dan Halley, thanks so much for that. Well, coming up, we are going around the horn and checking in on some of the top stories and trending tickers from today's biggest movers. Stay tuned. Well, stocks ending the trading day on a mixed note with the Dow down 140 points and the S&P 500 and Nasdaq in the green. Let's take a look at some of the trending stories of the day. Up first, a fake image of an explosion near the Pentagon set off a brief panic today, momentarily causing the markets to dip during the morning session. The image in question was first posted on Twitter, showing black smoke billowing near the Pentagon with the text, "Reports of an explosion." That image was promptly shared by a handful of accounts, including Russia's state-controlled media RT and an account claiming to belong to Bloomberg. That prompted the Arlington Fire Department to put out this tweet saying that there is no explosion or incident taking place at or near the Pentagon, and there is no immediate danger or hazards to the public. Guys, we kind of followed this in real time, and it really does point to two key things that we talk a lot about on the show. Number one, what this pay to verify environment looks like on Twitter today. Because the account that shared this did have a blue check mark, because remember, today, it's not about verification, it's about paying to get verified. The other bit, though, is, I would argue, a little more concerning, which is all indications are that this was an AI-generated image. This was not checked when it was shared on Twitter. And that raises a lot of questions about how quickly misinformation can move. And to be clear, we're not sharing the image because we don't want to add to that. But it certainly demonstrated the fears that people have about how AI could be misused.
It does, and it also strengthens the arguments that we've heard from Elon Musk, from Steve Wozniak and the like, saying that maybe we should pause the development of AI given the fact that there are so many concerns about misinformation and how quickly that can spread online. But Akiko, you bring up a great point, and it's also what I wanted to make when it comes to the future of Twitter and whether or not people are going to rely on Twitter as much as they had been previously, given the fact that there's lots of questions out there about the actual source of the account, whether or not a blue check, and obviously it doesn't, but it's not well known, at least just yet, that people can't necessarily trust someone with a blue check mark account because you can obviously just pay to get that blue check mark. So I think this is also going to kind of recalibrate a little bit of how people go and get their news, how much they're trusting Twitter, and also just brings up a lot of questions about the future of AI, what that exactly looks like, and why maybe this strengthens the argument for regulation, and the quicker, the fastest that we could get regulation, why that's so necessary given all the risks that are on the table right now.
And on that point about Twitter, what if the Arlington Fire Department, what if that was a fake account that was created and said, this is real? And that could even have more dire consequences. We saw the S&P 500 dip on the heels of this news. So this has serious, serious consequences if left unchecked. I think verification for both accounts and also these deep fakes, any manipulated photos or videos, that needs to be paramount. I don't know if there's more technology, obviously there is, that needs to be developed and be embedded in the Twitter platform. But like Sean has said, and Kiko, like you said, I do think this raises serious questions about the future of Twitter. And even for our business in media, in journalism, we need to make sure that these things are verified before we say anything and potentially spread this misinformation.
I have to say, guys, for me, this felt kind of like a visceral gut punch. I actually had an emotional experience seeing this story. And partially that's simply because in the end, AI is really difficult to discern. It makes it difficult to discern what is true and what is not. And one of the most concerning things to me actually was not the Twitter stuff. It was the fact that it was also circulating on Google. And it's just a sharp reminder of the fact that our definition for misinformation, we imagine text, but we have to define that as to images. You can't always trust what you see, which is really scary.
And Ali, worth noting that those who are very in the weeds on forensics of these digital images do point out that there's ways to decipher whether in fact something is an AI generated image or not. Specifically Bellingcat, of course, we know them as this investigative outlet. They say, one of the reporters said that you could tell by the way the fence melts into the crowd barriers. That's number one. That shows you that's not a real image, but also look to see what other images are being shared. In this case, it was the exact same image that was shared. And that's usually a red flag that it's not a real event that's happening, or the image is not real.
And we will, I think, get better at time in terms of distinguishing what's real, what's not. But the tech will also get better. On the subject of tech getting better, my play here is Amazon. Amazon's always got something new, and today it's paying for alcohol by swiping your hand. This announcement is an expansion of the company's Amazon One service, which is a palm reading frictionless payment option that they've rolled out in several retail locations, like, for instance, Amazon Fresh stores. I've got to say, though, even though Amazon One was launched in 2020, this seems to be a statement of confidence to me about the technology itself. Alcohol, of course, is highly regulated, and there's far less margin for error with alcohol than, say, a box of Special K. However, we could see some pushback here. For digital privacy advocates, Amazon One has absolutely been a target.
Look, I love anything that makes it easy for me. Personally, when I go to the subway and I can whip out my phone and just tap and get right on the train, that's a win in my book. I am a little concerned with all of the intense advancements when we think about biometric tracking. Now, Amazon does argue that the palm is more private than perhaps your eyes or fingerprint. That gets me a little worried in terms of privacy, but ultimately, if my privacy can be contained and I just have to go like this to get a bottle of wine or a Kettle One, I mean, I do think it makes it much more efficient. And I think we're going to see more of this technology moving forward, in my opinion.
Yeah, I think that Amazon's obviously making the case that you should trust their handling of your data, why you should not be concerned about what in fact could potentially get out there. But I am, as a consumer, it does make me think twice. I am going to be one of those ones, if I were to ever travel to Coors Field, where this is going to be available first, if I'm given the option, you have to sign up for it. There's a number of things that you have to submit, several pieces of information in order to qualify for this. But I am going to think twice. I'm going to let some other people experiment with it first, make sure that their data is not leaked, nothing bad happens to them, and then I will jump on board. I'm not doubting that this is the future. I think obviously Amazon is the leader when it comes to this space, but it is a little worrisome in terms of your own data getting out there, but also just how much data, Akiko, Amazon has on you. They're already, I feel like, have so many aspects of my life covered. This is just one more data point that they will now have, which is a little unnerving.
To which I respond, Shauna, by saying, how much data do you have on this?
So much.
Right? I mean,
exactly.
They have
Make
my
a good
face,
point.
they have my thumbprint, they have everything. And I'm with you, Allie. Whatever makes it easier, I have a tendency to move in that direction. There is initial hesitation, but I will say from Amazon's perspective, what does it mean? Well, it means that they can target their products. Their ads can be targeted even more because they've got more data on you. From a business standpoint, it's what they're looking for.
Yeah, it gives them a huge advantage, that potentially, that's for sure. All right, well, my play today is Walmart, the retail giant, going after pet owners with a new perk. So get this, Walmart Plus members will now have access to pet telehealth. This is through a partnership with provider POP. Now, it's the company's latest move to better compete with Amazon, which has a very similar offering, and also deepen its customer loyalty. And it could potentially pay off here. We've talked about this a lot in the past. The pet industry long being viewed as recession resistant, and we know Americans have been spending big bucks when it comes to their pets. It's a very fast growing sector. Right now, right around $123 billion. Well, that market is expected to grow all the way to $200 billion by 2030. My question, though, I get telehealth when it comes to humans. For pets, I think it's going to be very complicated for a veterinarian to try and figure out what is wrong with your pet without bringing them into the office and being able to do some tests.
Shauna, I got very personal here. I wanted to know if my little brother, he has a dog, Theo. I'm going to show a video. This video was not created by my brother, but my father. So this is the grand doggy. And I just wanted to show this to show how intense pet owners are. This is little Theo. I said to my family, I said, would you sign up for Walmart Plus if they had the free telehealth visits incorporated? My mom immediately goes, wow, that's great. I'm going to sign up for Walmart Plus right now. My brother, who is 27, younger, he questioned it. He said, I don't know if that alone would make me sign up for this service. He was more enticed by the free streaming services, the discounts on gas, the delivery, because he said, if I had a real issue with my dog, I would go in person to the vet or I would email them pictures. He didn't quite see the value of telehealth, but I think, again, to my mom's point, that older generation, they hear that and people love their dogs so much. Your initial reaction is to say, heck yes, I'm signing up for this.
I just want to know how effective it is. Shauna, the question you asked is the number one question I had. How do you know on telehealth how your dog is doing? That's what I want to know. How does that service work?
I have no idea, but I don't own a pet, but just as a bystander here, if someone's pet was hurt, I would want them to take it into the veterinary just so they could get a better scope, a better idea of what the heck was going on, rather than just relying on video. When the dog can't talk, cat can't talk, obviously.
Well, the other thing about this too is I actually took the same tack as Allie, and I asked my mom. I said, okay, Mom, would you use this? And she was sitting at Canasta with a group of dog moms in Miami, and lo and behold, they all said, absolutely, I would love that. So Allie, I mean, older generation seems to be on it.
They seem to be on it, and you know what, we're talking about pets. David Zaslav, CEO of Warner Brothers Discovery. He's not a teacher's pet, at least not at BU. Here's why. Take a look at this.
I have the honor to present David Zaslav for Boston University's honorary degree.
David Zaslav, you are a lawyer, executive, and media visionary. But above all, you are a storyteller.
Oh, guys, it's so cringy. That is David Zaslav being booed by crowds while speaking at Boston University. And guys, this largely had to do with the ongoing writer strike. Warner Brothers Discovery, along with some of the other major studios like Netflix and Disney, currently in those talks. And BU was criticized by their students by announcing that Zaslav would be the guest speaker one day after the strike began. There were people on the picket lines, they had signs, there was chants saying, get off the stage. I mean, this was really intense, and really, it gave me it concerned me. It scared me.
It was very intense. You mentioned those picketers outside of the commencement ceremony. It was estimated over 300, about 350 people reportedly had been marching earlier that day. You got to give it to David Zaslav, I think, in this scenario. I could barely watch it. I was so awkward just watching this after this happened. He didn't look too shaken. He looked confident. He continued on with the message, with the speech. He might have altered it just a bit, given the fact that his audience was being so aggressive with their boos. I thought he, though, did a very good job at handling this.
And it wasn't just boos, guys. It was a chant of pay your writers. So this was a very personal one. But you know what? I mean, to that point, Shauna, I think the executives are used to this, but this points to just how intense this discussion has gone. Because BU is far, far away from Hollywood, but it is about executives, you know, organization and paying, or at least meeting their employees where people think they should be met in terms of pays and benefits.
This is the thing for me here. I had one headline thought, and it was, this is an exercise in public humiliation. Was this really necessary? Who let him do this? And I live in LA. I've sort of seen how the writer's strike has started to affect a lot of people in Los Angeles. And it's the sort of thing where I would keep going, yes, this is super cringy. Yes, has there ever been a good commencement speaker ever? But also, did this have to happen at all?
Yeah, well, certainly just speaks, like Akiko said, to this issue. And so many people obviously very passionate about what happens here. All right, well, coming up, Meta's battle with EU regulators taking another turn. It slammed for a record fine for data transfers. We'll dive into the details next.
Well, Facebook's parent company, Meta, is getting hit with a record-breaking $1.3 billion fine. The tech giant facing the penalty from EU regulators because of sending information of European users to the U.S. That was in direct violation with the European Union's privacy policies. Here with more on what this regulatory scrutiny means for Meta and the tech space, let's bring in Eurasia Group senior analyst Nick Reiners. Nick, good to talk to you today. The $1.3 billion price tag, certainly a very hefty one for Meta, but put this in context for us. How significant is this ruling, not just for Meta, but for the other big tech players?
Hi, thanks for having me on the show. So it's very significant, firstly for Meta, because this is the biggest GDPR fine ever levied by any of the EU data protection regulators. And the GDPR is the EU's general data protection regulation. So 1.2 billion euros or $1.3 billion is the highest fine ever, but it's still lower than the maximum that could have been levied on Meta. Because the GDPR allows fines of up to 4% of total revenues, which would have been over $4.5 billion. So it's significant not only for Meta, but for the other big tech companies, because the other big tech companies all rely on so-called standard contractual clauses to transfer data from the EU to the US. And the EU data protection authorities decided that these standard contractual clauses don't provide enough safeguards for European personal data. So that means that the other big tech companies will need to find a way to safely transfer data unless the new EU-US data privacy framework comes into force in time.
Nick, do you see that coming into force in time? What do you think the timeline looks like for that and the pressure that the U.S. now faces as a result of this?
I think it will come into force in time. It's been a long time coming. It's been over a year since President Biden announced that a deal in principle had been reached when he came to Brussels a year ago. But now the I's are being dotted and the T's crossed, and it looks like the final decision on the European side will be done and dusted in July. So hopefully the full data privacy framework will be enforced by September at the latest, and that's going to be in time for Meta because the Irish Data Protection Commission has given Meta a 5-month transition period in which to get ready. So they have allowed enough time for this new framework to come to force.
Nick, we have seen the EU really crack down through GDPR, but they're certainly not the only ones that have called for storing the data of their own users back home, not abroad. We've seen the same argument here in the US as well. I mean, you talk a little bit about the logistics of that, technically, whether that's difficult at all, and whether in fact that's where we're headed because of the sheer concern about data collection and what that means for national security.
Indeed, it does seem like there's a lot of movement in that direction. I mean, technically speaking, when we talk about data being transferred across the Atlantic, it's not really how it is in reality. In fact, data can cross the Atlantic many times a day. So it's the technical reality doesn't always correspond to how we perceive it in our minds. But there is this huge concern about US surveillance practices, and that is the fundamental problem, as Meta has pointed out in their response, that there is a clash between European privacy law and US surveillance practices. And that is what the EU likes to call a matter of digital sovereignty or data sovereignty. And as you say, there are other regulations that demand the same kind of data localization policies. We're seeing a new EU cloud certification scheme that is making US companies very upset and the US government very upset, because it would essentially force US big cloud providers to set up a joint venture with an EU firm and store all European data in the EU, and even have that company potentially controlled, majority controlled by a European company.
How do you think this changes the way that tech companies operate? I mean, to your point, yes, there's a conversation happening between the US and EU. As you say, there's likely going to be some kind of framework in place about data collection, but we're coming off of years of these tech companies not having to worry about where that is. And increasingly, we are seeing data having to be kind of walled up.
Indeed. If this data privacy framework, if it is again struck down by the European Court of Justice, like its predecessors, Privacy Shield and Safe Harbor, then companies might really be running out of options because the data protection authorities have decided that these standard contractual clauses don't work. That really removes one of the very last legal workarounds. So it might be that they have to start constructing dedicated data centers in European soil. But in fact, many of them are already doing this because they see the way the wind is blowing. And in some cases, it's not quite as difficult as sometimes made out. It's possible to rent data storage solutions. So they will find a way.
Nick Reiners, good to talk to you today. Appreciate your time.
Thanks very much.
HBO Max's official rebrand to Max starts tomorrow. Yahoo Finance's Alexandra Canal, of course, following all of this. Other than the drop of HBO, what can users expect?
Well, it's all happening tomorrow on Tuesday. The Max platform, it's been highly anticipated. We heard some details in April. There's going to be 3 different pricing tiers. If you take a look at some of that pricing, we have a $9.99 a month fee for the ad-supported version, $15.99 for the ad-free option, and then a new ultimate ad-free tier for nearly $20 a month. Now, that ultimate tier allows 4 concurrent streams and 4K streaming options and is the only new option. The other tiers do match the current pricing of HBO. Now, how this performs is going to be a critical element considering how many challenges Warner Brothers Discovery has faced since that Warner Media and Discovery merger last April. Earlier this month, we did see WBD reverse those streaming losses as subscriber numbers came in above consensus estimates. The company has been praised for being able to really cut costs. We recently heard from Needham analyst Laura Martin, who said the fact that Discovery Plus has less churn, coupled with the strong content of HBO, that could be the secret sauce needed to be a powerful player in this competitive streaming space. So, you know, a big debut at a critical time. We'll see if the subscribers want to sign up for this.
We will see. Certainly a lot of pressure on Zasloff and team there. All right, thanks, Allie. President Biden and House Speaker Kevin McCarthy will be meeting soon to discuss the debt limit. Well, earlier today, our Rochelle Akufo spoke with former Senator for North Dakota Byron Dorgan about one of the ideas being discussed to avert a default, the 14th Amendment.
I don't think the 14th Amendment is in play here. I mean, they talk about that, but I don't think it can happen in this round. And it would take some while to implement it if they decided to try to do it. So I don't think it is going to work by June 1st. But let me make another point. The fact is, the Republican leader comes to the White House and says, we demand you do what we insist on, or we're going to default on the federal debt. Well, look, the fact is, our fiscal policy, Republican and Democratic fiscal policy, is way out of balance. It is way unsustainable. There does need to be budget cuts. There does need to be some tax increases. And we need to put this thing back in order. And that ought not be a part of the threat of defaulting on the federal debt. That's money that we already owe. We've spent that money. So now I think Republicans and Democrats have a responsibility to decide that we're going to extend the debt limit and then have serious, thoughtful budget negotiations to finally figure out how on earth do we get this issue dealt with of less spending, and we need to have less spending, and also increased taxes.
And as you mentioned, this is something that both parties have contributed to over the years to get to this point then. So then what are the expectations then for what can happen in order to avert defaulting on, as you mentioned, this spending that's already happened?
Well, you're right about both parties. I mean, the fact is both political parties own this problem. In fact, just during the presidency of Donald Trump, the fact is he increased the federal debt with a Republican Congress by almost a third, $8 trillion. So this is not just a Democratic issue. It's Democrats and Republicans. And I just really believe that there needs now to be some kind of approach in which the American people say to their representatives in Congress, you've got to fix this. Now, let me just make one other point, if I might. We have a different kind of Congress than we've had in the past. We've got, a handful of people in the Senate who are not somewhere in the middle. They're way off on the right. We got 40 people in the Freedom Caucus in the House, some of whom think defaulting on that would be probably a pretty good thing. I mean, that's unbelievable. I think it's reckless. I think it's dangerous. And I don't know what's going to happen at the meeting this afternoon. It occurs between just the Speaker of the House and also the President. This will be a very important meeting, but both of them need to understand even as we fix this issue of dealing with extending the debt limit, I hope we do, because to default on the debt would be devastating for our country. Even as we do that, our fiscal policy is unsustainable, and both this president and this Speaker of the House and others need to resolve it.
So what do you think is the most likely scenario then at this point?
Somehow I think they need to find some way to reach some agreement on portions of the recommendations that have come from both the White House and also the House of Representatives. I think Republican leader McConnell is sort of staying off to the side on this. So it's just the president and the House of Representatives. So my hope is that they will find a way to at least take some of these positions, not all that many, and then extend the debt limit, then come back and really do a significant issue. You know, those that say, if we don't get what we demand, I'm talking about the Republicans in the House, if we don't get what we demand, we will hurt ourselves, because the fact is everybody will be badly hurt. So it's just a stupid position to be saying, we demand this or we won't pay America's bills. We won't pay our debts. That makes no sense at all. And Republicans and Democrats need to understand that and need to find a way to help fix this.
And for other countries sort of, looking in, wondering, why should we care? I mean, when we look at Mark Zandi, the chief economist at Moody's Analytics, saying no corner of the global economy will be spared if the US government defaulted and the crisis weren't resolved quickly. When you think of the repercussions and what this means for US standing, not to mention who we trade and do business with, what should some of these CEOs who are also watching this be thinking right now?
Oh, I hope all of those CEOs and others call in and say, look, this needs to get fixed. But the fact is, the American dollar is the international currency. This will have a profound impact on that if America is seen as a country that has decided we won't pay our bills. We won't pay the bills that we've already encompassed, and we've spent that money. We've got all these bonds out there. Other countries have purchased these bonds. We need to tell the rest of the world that they can count on the American dollar. And even as I say that, I say again, our fiscal policy is unsustainable in the long term, and it needs to be fixed. But don't fix it by deciding you're going to threaten to default on America's debts. That makes no sense at all.
And as you mentioned, other timelines they can use to solve some of these fiscal problems, with budget talks as well. So if you had a message for both sides today, when you think about some of the major sticking points that both sides still do have, what would you tell them?
Well, I just find a way to convince everyone that as they extend the debt, if they can find the votes to extend the debt limit, that there are guarantees that they will, in a thoughtful budget process, figure out how we deal with this unsustainable fiscal policy. And, there needs to be promises of how you deal with that on both the spending and the taxing side. I hope they would reach those approaches, and they can say that to Republicans and Democrats in the Congress. We'll see. This is detrimental. It's already very detrimental to our country to 24/7 for weeks be talking about the fact that America might default. That is already detrimental to our country. I hope we get to a point very quickly here before June 1st that we can solve this and just decide we're going to extend the debt limit and then fix the other unsustainable fiscal policy issues.
Let's take a look at what's trending after hours, and that is Zoom. You're looking at shares up nearly 2% in extended trading. It had initially popped right about 5% here. The company issuing earnings actually beat the street's expectations. Revenue up 3% on a year-over-year basis. The guidance was also better than what the street had been looking for, yet we are seeing a bit of that initial excitement cool here in extended trading. In terms of what Zoom did not do so great here in the most recent quarter, enterprise customers, that missed by just about 2,000 accounts, and also the customers contributing more than $100,000 over the trailing 12-month period. That number also came in below expectations. Zoom, since the start of the year, is actually in positive territory, up just about 5%. But taking a look at that one-year chart, we're looking at losses of about 20%. But taking a look at the two-year chart really paints a much better picture. We know Zoom, obviously one of the pandemic darlings here during COVID, shares off nearly 80% over the last 2 years. So investors looking for the company to do something a little bit different in order to regain anything like the excitement that we saw about 2 years ago, Kiko.
Well, it is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. Meta is being fined $1.3 billion by EU regulators who say the tech giant broke privacy laws when it sent European customer data to the U.S. Meta says it will appeal the decision. Meta shares ending the day slightly higher, though, up about 1%.
A peer review study suggesting that an oral weight loss drug from Pfizer may work faster and be as effective as Novo Nordisk's Ozempic, which is an injection. Now the news sends shares higher, with Pfizer closing the day up just about 5%.
And looking ahead to tomorrow, we've got a long list of retailers set to report their quarterly results. Lowe's, Dick's Sporting Goods, BJ's Wholesale, Williams-Sonoma, and Urban Outfitters are among those reporting. And given what we've heard from Target and Home Depot, we're going to be listening closely to see if any of those retailers are also seeing consumers starting to turn a little more cautious with their spending.
Busy earnings day tomorrow. All right, well, that will do it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here at 3 p.m. tomorrow. Have a great afternoon.